All right. Hello, everybody. My name is Sam Levey. I am a graduate student in the economics department at UMKC in Kansas City. And the talk here is called Modeling Monopoly Money. So this is the paper. If you care to read it, it just came out about 2 weeks ago as a Levey Institute working paper. So you can find that on their website or with the URL here. Here's a couple of quotes to motivate what I'm up to here. So the first one is from Warren Mosler. Every time the government pays more for the same thing, it is redefining its currency downward. Another one from Keynes. There is, therefore, no grounds for the belief that a flexible wage policy is capable of maintaining a state of continuous full employment. Okay, so what am I doing here? The purpose of this is really to respond to critiques of MMT that say things like MMT doesn't have a model. Now, I think even without my paper, that is just false. It does have a model. I did not invent the model for this paper. Now, I'd say it's actually got a handful of models. The main one has to do with sovereign currency or monopoly money. And this link to this YouTube video, and I can share this in the chat later or something, but it's a pretty low quality video, but it's Warren Mosler giving what I think is a very nice performance of this verbal model. Another place to look for models that MMT uses is this website here, this Wixsite website, which is called Modern Monetary Theory for Mainstream Economists. You can type that URL or just Google it. And item number 3 on that page has a list of different sort of theories, models, lenses that MMT uses. So I'm not inventing the MMT model here. What I'm doing is just turning some of it into math, just writing some of it in the language of math, mostly for the purpose of shutting up critics. Okay, so I do want to throw some disclaimers therefore on this. The first one is that mathematical modeling just is not the most important thing in the world in my estimation. The purpose here of making this model is to make a communication tool or a teaching tool, right? It's a simple model. It doesn't have all kinds of things that are important in the real world, but that's not the point. The point is just to demonstrate a mechanism in a language that some people find more understandable. Right? If this language doesn't work for you, then don't worry about it, because there's another language that, there are other languages we use to convey these ideas, but this is just one of them. And then a disclaimer about the model itself. A lot of the things in the model are backwards from what you might be more used to, both in your everyday life or in any of your previous economic modeling experience. And that's because what happens in the model is that people are trading money. And so the price of things is the price of money, which is the sort of the opposite of the normal prices we're used to, which are the price of the things you buy with money, right? And when people in the model, they don't really buy goods, they sell money, right? It's the same thing, but it's described using the mathematics in the opposite of the way people are used to. So you have to kind of track that as it goes on. Okay. All right, so first, a couple of comments on the mainstream paradigm. The mainstream macro paradigm starts with Walrasian general equilibrium. You've got buyers and sellers. They meet in the market. They exchange goods at prices called out by an auctioneer, and the auctioneer tries to find the prices where supply equals demand in all markets, right? So in the simplest version of this model, there's no government, there's no money, there are no power differentials of any kind, really. And so unsurprisingly, those models produce continuous full employment, and they really have no explanation for the price level, only relative prices. Okay, so to obtain these more realistic aspects of the world, like we do have a price level in the real world, we have inflation, we have involuntary unemployment, you have to add things ad hoc to the mainstream model. You add sticky prices or you add a Phillips curve, and that's where their theories of these phenomena come from. Okay, there's lots of critiques that heterodox economists have thrown at that project, and I'm not really going to go over them. But what MMT adds specifically is that that project doesn't take the state's monopoly on its own currency seriously. The government is the monopoly issuer of its own currency, and that currency is in high demand because of the need to pay taxes, among other things. In monopoly markets, well, monopolists have market power. There is no market price. The monopolist just tells you what you have to do to get the product, and that is the price. And if the monopolist refuses to supply enough of a good to meet the demand, then there is no such thing as a market process to make it clear. There just will be an unmet demand, right? That's the nature of monopoly here. So what MMT does is take those ideas and apply them to money itself, to the government's currency. In that case, the price level is determined by the prices that the government pays when it spends. And if the government refuses to supply enough of its currency to meet the demand, the markets simply aren't going to clear, and you'll have unemployment. Okay, And I'm using a little asterisk here. Technically, we should be talking about net financial assets, the net financial wealth of the private sector, but I'm going to use the word currency most of the time in meaning that more specific thing. Okay, but so you might respond to that with this question: is the government actually a monopoly? Because it's clearly not the only seller of its own currency. The government sells currency when it buys goods and services or labor or what have you. But then the currency goes out into the economy and now somebody has it and somebody else can sell it too. When I go to the store and I buy a cantaloupe or something, I am selling money to buy the cantaloupe. So there are lots of sellers of money. And the question might be, well, isn't the government in competition with those other sellers? Does it still have pricing power given all this competition from all these people who are selling money all over the place? So there's some related literature that I draw on here from mainstream econ, specifically in industrial organization. That looks at monopoly in the case of a durable good, right? The monopoly model that you learn in intro micro assumes that the good can't be stored and can't be resold, right? You buy it and you consume it and it's gone. But what if it's durable? You buy it and it lasts. And then there's markets where you can resell them. So this case is called duopoly, durable monopoly, duopoly. One particular episode that's relevant in the literature is around the court case of United States versus Alcoa. Alcoa was the monopoly producer of aluminum at the time, but there was a very competitive secondary market in aluminum, people recycling aluminum from previous uses and selling it back on the market. And so the question is like, does Alcoa have market power? Should they be regulated like a monopoly, even though there's all this competition they have from the recycling market, right? So that's the question. And so a general result from this literature that I'm borrowing here is that the monopoly producer can retain market power if there's some reason that the outstanding stock of the good is insufficient to meet the community's demand. So one way this can happen is if there's some process removing units from circulation, right? If there's some like recycling losses, or there's just some inefficiencies and they just lose aluminum over time to this, then well, their aluminum is steadily draining out of the market. And so eventually, if that went on long enough, people would sort of run out and they'd be forced to go back to the monopoly producer who can then charge what they want. So if there's something removing units from circulation, then that gives pricing power to the monopoly producer, right? And for state money, that process will be taxation. Okay, so here's an analogy. What determines the price of a subway ticket, like on the train, on the underground? Well, it's the Metro Authority. They're the monopoly issuer and they set the price. If they charge $2 per ticket, then the ticket costs $2. Okay, but same thing, you can buy a ticket and it survives. You can resell it to somebody else if you want. It's a long-lived asset, right? So it's not a pure monopoly in the same kind of way that we might be talking about with like blueberries or something. So it can be resold. And so the resellers are effectively competing against the monopolist. And so not all transactions are going to happen at the official price, right? But we would expect that any private resale price is not going to get too far away from the Metro's price. If the Metro charges $2 for a pass, then we'd sort of expect secondary market transactions to happen somewhere in the neighborhood of that price too. And if Metro raised the price, then we'd expect the secondary market transactions to follow. And why is this? Well, it's because when you ride the train, when you redeem the Metro passes and you return them to the Metro and get your train ride, now there's just fewer out there, right? And so redemption removes the passes from circulation. Eventually, if that goes on long enough, people get forced back to the Metro to resupply the passes, right, to get new passes. And if the Metro just didn't provide enough to meet the demand, well, then people won't be able to ride the train, right? The passes can't come from anywhere else. Okay, so in the model, how do I replicate this? Well, the model, I should say, is in two parts. The first sort of half of the paper looks at this idea of pricing that I've been talking about. And the second half extends the model a little bit to look at unemployment. So we'll take this first part here about pricing. So we're going to look at whether or not the government has market power over the currency, even though there's this existence of a resale market for fiat money. So the government spends money to buy labor. So it's selling money, buying labor, and that puts fiat money into the hands of people in the market. And then those people can resell that money, again, for labor, to keep it simple. And so there's going to be two prices here. There's the price that you pay to get money from the government. This is the wage the government pays when it hires workers. But there's also the price that you could pay to get money from the private sector, how much labor you have to supply to a private seller of money to get money from them. All right. And so because there's two prices for the same thing, I like this cute little nickname that I've got here. I call this the dual price model. Okay. And so the question is, what we want to know is it possible for these two prices to be different from each other in the long run? Or is it the case that if the government just fixes some price, they just choose the price that the government's going to pay, is the private market price attracted to that price? Is it going to be forced to become equal to it? Or can they just be totally disconnected from each other, right? That's the question. Because if something forces the private market price to equal the government's just totally fixed exogenous price, then the government seems to have pricing power. Or if there's some possible long run steady state where they just have nothing to do with each other, then it seems like the government doesn't have pricing power. Okay, so the government's going to spend money into the economy. They'll spend tax credit liabilities, fiat money, currency. I'm going to use those terms interchangeably. And they're going to tax them back out. And we're only going to look at one kind of government liability. So we're not going to look at bonds or anything like that. We're just saying the government spends money into the economy and taxes it out. So note that deficits add currency into the economy on net. And so government surpluses remove it. So here's the first equation. V is the stock of outstanding government liabilities or currency in private hands. G is government spending. T is tax revenue. So the change in the stock of government liabilities is equal to the government deficit. Here's the demand for government liabilities in any given period. So this is how much money people are trying to buy each period, corresponding to how much labor they're offering, right? They offer labor to buy money. Here's how much money they want. And the way this is specified, P here is the price of money. So this is how much labor you have to supply to get $1, right? So if 1 hour of labor pays $15 per hour, then the price of $1 is 1/15 of an hour's worth of labor, right? So what this equation is saying, and the easiest way to think of this is if you multiply the P across to the other side. So then D is in dollars and P is in hours of labor per dollars. So P times D would give you hours of labor. So that's equal to A is just a constant that tells you how much money you're trying to have each period in terms of labor hours. So it's saying like, oh, I would like to earn 10 hours of labor worth of money. That's what A is. And that's how I model the demand here. Yep, that's what I just said. Okay, then there's the supply of money to be resold. So after people get the money, they can resell it into the market. And how much are they going to want to resell? Well, this is a very simple model. You could do all kinds of more complex things, but this is simple enough to get the job done. And it just says, so S is how much money people want to resell. K is a constant. And V is just, remember, it's government liabilities again, and it's the amount from the previous period. So it just says, spending today, how much money I'm trying to sell is just proportional to how much wealth, how much financial wealth, net financial wealth I had yesterday, right? So K is sort of like a spending velocity of money, but whatever, it's a wealth effect. If I have more wealth, I have more money, I'm going to spend more. That's how this works. And then just a couple of nice properties, right? Note that if V is 0, if there is no net financial wealth, then there's no money to be sold. So my selling of money is 0. So that seems sensible, right? K doesn't need to be a constant. It could be like an upward sloping function of the price or whatever, but you could treat it as a constant. That works too. And then K also does not need to be less than 1, okay? V is a stock. It tells me how much money is currently out there, how much financial wealth. S is a flow. It's how much money I'm trying to sell or how much spending I'm trying to do. So you can support any amount of spending with any amount of money, right? Even though if there's only $100 in the universe, we can still spend thousands of dollars per month or whatever. So K can be more than 1. Okay, so let's talk about how fiscal policy works. So we'll just have fixed taxes. And then what the government's going to do is they're going to hire workers, they're going to buy labor, and they're going to pay a fixed wage, which is given as PG. And so that's the fixed government price there. And for now, the way I'm going to do this is that they're not going to hire a particular number of workers, but they're going to hire anybody who wants to work. So this is a job guarantee, right? They're hiring any people who show up for work and they're going to pay them a fixed wage. That's the job guarantee. That assumption is not necessary to get the conclusion that we're going to see out of the model, but it just makes it simpler. And then we'll relax that later. Now, two more variables here, DF and DG are going to represent what transactions actually end up happening in each market. So DF tells you how many dollars actually get bought and sold in the private market. And DG tells you how many dollars actually get bought and sold in this government exchange, right? So those are like the actual outcome of the transactions, and we'll talk in a second about how those are determined. And then we also have the second price, PF, is the private or resale price of money. So PF, the private price of money, DF, how much money gets bought and sold in the private sector, PG, the government price of money, DG, how much money gets bought and sold, or I guess just sold by the government, because they don't buy any. Okay, and here's how those are determined. So we've got DF and DG, and they're determined here. And this is actually pretty simple, and you can think about intuitively. What happens is the people who want to buy money go to where it's cheaper to get. If it's easier to get the thing you want to buy from one seller, it's cheaper, you go to that seller first, right? So if the government's offering a better price of money, then I would like to buy money from them first. So I'll go to them first. Or if the private sector is offering a cheaper price of money, it's easier to get money from the private sector, costs less labor, then I would like to go to them first, right? So in this first column here, if the government price is lower than the private price, so it's easier to get money from the government, then I will take my entire demand to the government. And because it's a job guarantee, the government will fill the entire demand. So the amount of transactions in the government market is just the entire demand D, which means nothing is left over to happen in the private sector, so that's 0. On the other hand, in the case where the private price is less than the government price, so it's easier to get money from the private sector, it requires less labor, it's a better deal, then I'm going to go to them first and only go to the government if I have any leftover demand. So in this case, in this column here, the demand is less than the supply to be resold, which means the private market can fill the entire demand. And so the government's going to end up selling no money because the private sector has sold all the money that people want. On the other hand, if the demand is greater than the amount that can be filled in the private sector, it's greater than the resupply, then in the private sector, they're only going to fill up to S, only as much as they're willing to supply. And the people who still want to buy money are going to have to go to the government to get the rest, D minus S. Yeah. So that's how that works. And you can just take my word for it, but you can express those in these two equations. If somebody's really curious about how this works, we can talk about it later, but these two equations just capture what this table does. Okay, and then finally, we're going to need some rules to govern private price adjustment. The government's just going to hold a fixed price for now, but the private sector will adjust its price according to the conditions on the market, and they will do that according to supply and demand, just super simple supply and demand model. Okay, so there'll be a couple of factors that determine whether or not prices change. And I'm going to list what those are, and then we'll see how they affect the price. So the first one is unpurchased supply of the currency. So this is people who take money to the market and they would like to sell that money, but there's nobody to buy it, right? So the total supply minus how many transactions actually happen in the private market, this leftover is just unpurchased or unplaced money, right? And we would think, well, if there's more supply than there is demand, that's going to lead price. That's going to indicate prices should fall. We have the reverse too. If there's unfilled demand for money, so people go to the market and offer labor, but there's nobody there to sell them money, there's more demand for money than there is supply, well, that's an indicator to raise prices, right? And so this is total demand minus the demand that actually gets filled. So if there's any unfilled demand, excess demand, raise prices. This last term is a little bit complicated. And what's going on here is, well, if there's a job guarantee, then like think about that. There can't be unfilled demand because the government is filling any unfilled demand. That's what a job guarantee does. But you'd kind of think about if you're a seller in a market and like, let's say there's not some imbalance, supply equals demand, blah, blah, blah. But you notice that everybody else is charging a higher price than you. Well, that might be an indication to you that you can raise your price and get away with it and not lose business, right? If supply and demand are being fulfilled, but everybody's charging a higher price than you, that might be an indicator that you should raise your price. So what happens here is, if the government is filling this demand with the job guarantee, but they're offering like they're charging a higher price to sell money than the private sector is, than private sellers are, that's an indicator to them that maybe they can raise their price and get away with it. Yeah, so that's how that works. And I'm not going to talk about how this math expression works, but if somebody's interested, we can come back to it later. So here's the price adjustment rule out there in the private sector. The hat above the P indicates rate of change. And so if the rate of change is positive, that means the price is increasing. If the rate of change is negative, that means the price is decreasing. This phi here is just a constant. And then in the parentheses, we've got the market imbalance terms that affect the price. So unfilled demand, excess demand, raise the price. If we've got this thing where we should creep prices up to match the other seller, raise the price. On the other hand, if there's unplaced supply, there's excess supply, you should lower the price. So that's why there's a negative sign there. Okay, so those are the equations of the model. And then our next task here is to ask, well, what happens? Like, how does the model behave? And to ask that, we want to find the like long run or steady state or equilibrium position of the model. Again, what we're asking is, can we reach some steady state where private prices totally ignore the government's exogenous price? Or are they going to force to be the same thing? So we'll solve for the steady state, and I'll show you quickly how we do this. First, in the steady state, because no prices are changing, right? All the market has to be in balance. So these imbalance terms have to be zero because the price is fixed. It's not changing in the steady state, in the equilibrium. Also in the equilibrium, the amount of wealth people have should be unchanging. The whole thing should be just static, stationary. And so that means the government's budget has to be balanced, right? The change in wealth is equal to the deficit. So if that's zero, then the government has to have a balanced budget in the equilibrium here. Okay, so we want to look at the two cases where the private price doesn't equal the government's price and see if those make sense. Because if those don't actually make any sense, then we're left with, okay, well, it must be the case that the private price comes to equal the government price. So let's look first at the case where the government price is less than the private price. So this is just the government is permanently offering a better price of money than the private sector is. Well, in that case, private transactions would be zero, because remember, we have a job guarantee. So if the government's offering a better price, everyone's going to try and get money from the government. And because it's a job guarantee, the government will supply money as much as people want at that price. Yeah. You can kind of think of it like, you know, when we talk about job guarantee proposals, we talk about $15 an hour usually. But what if the government said, hey, tomorrow we're going to pass a job guarantee and we're going to pay people $10,000 an hour, right? Well, pretty much everybody in the private sector would quit their job and get a job guarantee job, right? So that's like asking, like, can that persist in the long run? Okay. Well, if private transactions are zero, there's just no money reselling, then that kind of implies, based on the supply function we had, that the money supply basically has to be zero. This is just sort of a nonsense economy. There's no private transactions and there's no long-term money supply. So it doesn't make a lot of sense. What about the other case? What about the private price is just always better than the government price, right? So it's just easier to get money from the private sector than to get it from the government. Well, in that case, government spending has to be zero, because everybody is getting their money from the private sector and not the government. And this only makes sense, though, if taxes are also zero, because remember, we said the budget has to be balanced. So this case only makes sense if government spending is zero, and it only makes sense for government spending to be zero if taxes are zero. And so this case doesn't make any sense either. This case only can happen if taxes are zero. So these are nonsense economies. And so there we conclude, well, the only case that's left that makes sense is when those two prices are equal. Like, that's the equilibrium that makes sense. So that's the equilibrium where the government has market power over the currency. Okay. Now let me show you what this actually looks like when you simulate it. So the key graph of interest here is the one on the top left. The blue line is just the government's fixed price of money. And you see it's mostly flat here, but then what happens is I change it, right? So I let the model, I set it and then I let the model run. And then when it gets to here, then I change it. So now the blue line drops down to a new price, and then I let the model run for a while, and then I change it again, and now it's a new one up here. The orange line in the top left graph is the private price of money, and you can see it converges to the government's price. I just picked this government price randomly, and the private price eventually comes to hit it. And then when those two hit each other, then I change the government's price down to this new value, and look at that. The private price follows it. It eventually comes to be equal. And then I do it again. I change the government price up here, and look at that. The private price follows it, right? So the government seems to have market power here. If they just hold steady to their price, then the private sector has to follow. That's what happens in this model. Okay, so that's part one of this thing. That's looking at this price level theory and trying to mathematize this theory. Before I move on, let me just add like a couple of words about how this works. So to make it more realistic and a bit less abstract, imagine that the government said, okay, starting tomorrow, all of the prices we paid last year, we're still going to buy all the same stuff. We're going to order all the same tanks and, you know, accountants and whatever. But next year, just whatever prices we paid last year, for next year, we're just going to multiply them by 1,000. So whatever you paid last year, we're paying you 1,000 times more this year. Well, that sounds like it'd be pretty inflationary, right? Like for one thing, government spending is about to go through the roof. It's going to multiply at least by 1,000, right? Plus any like people who were before were choosing like to sell to the government or to the private sector, well, all of a sudden they really want to sell to the government, right? And they don't really want to sell to the private sector, the private buyers of the goods and services. They want to sell their goods to the government because they're paying a lot, right? And so like the whole government moves on to the government's budget. Aggregate demand increases a lot. Private sellers of goods have to match those prices to compete. So you'd think if the government says we're just going to multiply all the prices we pay by 1,000, it's probably going to cause a lot of inflation really fast. Okay, now on the other hand, the reverse case, what if the government said, okay, all the prices we paid last year, next year we're only going to pay 1/10 of those prices, or 1/100th of those prices, like cut it by 100. Well, at least at first, nobody's going to want to sell anything to the government because the prices in the private sector are a lot better, and the government is paying below market rate here. So why would we want to do that? So nobody's going to sell anything to the government, and so the amount of money government spending would promptly just drop to zero. So that's a huge breaker on aggregate demand. But taxes, meanwhile, are still happening, which is still draining wealth out of the economy. So, you know, this is going to be really painful and crushing, and it will force like mass unemployment and bankruptcies and piling up inventories. But eventually, supply and demand here is going to force private prices, the price level in the private sector, to deflate by 1/10 or 1/100th or whatever they say, right? If they really hold fast to that, that's what's going to happen. So that's what happens in this model. Okay, so I guess I'll go on to the second part here, which is the part about unemployment. So bear with me while I go through a few steps, and you'll see how this ties into unemployment in a minute. We're going to start by changing the fiscal policy. So instead of a job guarantee, we're going to have a sort of more traditional government spending. They're just going to buy some amount of labor, some goods they hope to obtain, and they're going to pay market prices. So instead of the job guarantee now, maybe they'll say like, we would just like to buy 1,000 hours worth of labor, and we're going to pay whatever it costs us in the market to get that much labor, right? Sort of more normal spending. Now, Mosler argues that they still control the price level, even if they don't know that they're doing it, right? Again, this quote, every time the government pays more for the same thing, it is redefining its currency downward, okay? So we'll see how that works. To model this, we're going to need two additional things that we didn't have before. First, instead of the job guarantee where the government spends the money to meet the demand, we're going to need it so that the government can spend less than that. So I'll show you how that works. And then we're going to need a way for the government to adjust its price instead of just having a fixed price like they had before. Okay, so in the first step, we needed a way for the government to spend a certain amount of money and not just whatever the market wants. So we're going to create a limit on government spending. It's that GL there. And in any given period, the government could spend less than that, like if there's just nobody who wants to buy that money, but they refuse to spend more than that. Okay, now this is going to make our table kind of complicated, right? And I don't think I'm going to go through this right now, because of time, but it's actually much more intuitive than it looks. Really what happens is, again, this is the top row, the people who want to buy money are going to go first to whoever has got the better price of money. If it's easier to get money from the government, I'm going to offer my labor to them first. Or if it's easier to get money from the private sector, I'm going to offer my labor there first. So go wherever it's cheaper to get money first. But then if maybe you fill all your order there, you buy all the money you want to buy, in which case you're great, you're done. But it might be the case that you hit a limit, because now before only the private sector had a limit of how much money they were willing to spend. Now the government has one too. And so whichever sector you go to first, if you hit the limit, then you've got to go to the other sector to fill any demand that you have left over, which maybe you fill it all, or maybe actually you hit that limit then too, in which case you just have some unfilled demand left over. Yeah. So that's what's happening in this table. If anybody wants to know how it works, we can talk through it later, but in the interest of time, I'm not going to do a detailed walkthrough of it. But you can take my word for it that that entire table can also be represented as these two equations, which again, are kind of messy. If somebody really wants to know, we can go through it, but otherwise you can take my word for it. Okay, so that is how the government can spend less than the market wants. We've got a limit on government spending. Now we're going to need to set what that limit is, and we're going to do it by saying that it's based on a particular target for how much goods, how much labor they want to buy. So GT here is the government's target amount of labor that they'd like to buy. You know, maybe this is 100 hours of labor. And given that this is however much labor they want to buy, you know, divided by the price of money tells you how much money they're trying to sell. Right. So the amount of money that government's willing to spend, or yeah, willing to spend, willing to sell, is determined by how much of the good they'd like to buy and how much it costs to do that. Yeah. Okay. So now we're going to translate that into the government adjusting its price. And same as before, there's going to be a couple factors that affect the government's price that make them want to adjust it up or down. The first one is unplaced supply here. If the government doesn't sell all the money that they want to sell, then they should lower their price of money so that they will sell more money. Translate that back into goods or labor. If the government doesn't get all the labor that it's trying to buy, then they should bid more. They should offer to pay more to get more labor. Right? So that's sort of straightforward. This one is a bit less straightforward, but really the way it works is that what this equation is saying is try not to overpay for labor too much, or try not to undersell the money too much. Because like you could think like, okay, if I'd like to buy a candy bar and the candy bar costs, you know, I don't know, $2. Well, obviously I have to pay at least $2 or I'm not going to get the candy bar, right? But the seller is, if I offered to pay $100, the seller would say, okay, I'll take your $100 for that candy bar. So the government doesn't want that to happen. And so they keep an eye on other prices out there in the market. They keep an eye on the private price and try to make sure they're not drastically overpaying for labor, right? So that's the other thing that's going to affect the government's price. And so then the price adjustment equation looks like this. Okay. And this model turns out to be wildly unstable. Like all we did was we made the government pay market prices for a certain amount of labor, and suddenly things are no longer so stable. We get this. This is inflation or hyperinflation. In the top left graph here, you can kind of only see the orange line, but the blue line is intertwined with it. These are both of the prices of money rapidly falling. So the money is becoming worth less. So that's inflation. Or if the government purchases just a little bit less labor, then we get the opposite. We get a rapidly rising both government and market price of money. That's deflation or hyperdeflation. Okay. Now, one thing that's interesting that I kind of wasn't expecting, but comes out of this model that's pretty cool, is you get conflict inflation. So people who know what that is, conflict inflation refers to like prices rising because people are trying to compete either for like a certain amount of goods or for their shares of real income or whatever. So this graph on the left, notice that this is just the same as the inflation graph, but just zoomed in a whole bunch. Notice that the prices are chasing each other downwards, and they seem to alternate which one is higher and which one is lower, right? So this is chasing, this is inflation, this is bidding against each other. In the graph on the right, The blue line is the unfilled supply of money in the private sector. So that's people who would like to be spending money, but there's nobody to sell goods to them. So when the blue line is above zero, people are trying to spend money in the private sector and they're getting frustrated. So what do? They offer a better price. They bid more for the goods they're trying to buy. And then in the next period, that goes to zero. So they're getting what they want. But look what happened over here. Now the government, this is government that's trying to buy goods and not getting it. So what does the government do? Well, then they offer to pay more for the goods. So then in the next period, that goes to zero. But now the private sector doesn't have the goods they want. So they offer to pay more, right? And so you get this conflict spiral that I thought was pretty cool. Okay. So about this instability, I'm going to say that the instability here happens for two reasons. The first one, if you think of the government's supply of money, it's according to this equation here, right? We saw this a few slides ago, that the amount of money the government's willing to supply is equal to the amount of labor they're trying to buy divided by its price. But that's, if you think of the graph of this thing in terms of price and quantity, that's like it's a hyperbola. It's like a 1/x curve. It's a downward slope supply curve, right? So with negatively sloped downward slope supply curves, you can have unstable equilibria. But that by itself, though, doesn't really cause all the problems, because the government's only a small portion of the market and the private sector supply curve is well behaved. So like, it should really wash this away. But there's another thing going on here, which is the accumulating impact of government deficits and surpluses on private wealth. So what do I mean by that? Please remember the basic MMT point, that the public debt is equal to the private wealth, or that government deficit is equal to the non-government surplus. So for instance, if the government is running a surplus forever, then that implies that private wealth, or private net financial wealth, is decreasing continually, right? Or if it's a deficit, it's the opposite, right? And you'd expect, if private wealth is just falling forever, then it's going to drag private spending down with it, right? And I've got the asterisks, right? A more technical way to say it, government liabilities are equal to non-government net financial wealth, but okay. So anyway, the accumulating impact of government deficits or surpluses on private wealth. If they're running a deficit, private wealth is just getting bigger. If they're running a surplus, it's just getting smaller, and it keeps getting smaller and smaller. And so private spending, we'd think, probably should follow that. Eventually, maybe not one-to-one, but that should keep getting smaller and smaller as well. So that's where this instability comes from. Now, here's a way to represent that on like an aggregate demand, aggregate supply plot. These are terrible models. You shouldn't really use them, but I'm just presenting it here as a kind of a heuristic. Don't take it too seriously, but this is the case where the government's running a surplus in this version of the model. And because they're running a surplus forever, private wealth is just falling forever. And so private spending just keeps falling and falling and falling. And you see that as this green, the aggregate demand curve, shifting to the left, to the left, to the left, and it just keeps going to the left, dragging private spending down as a result of the accumulating impact of the government surpluses. So let's suppose that, we start off at this point here, and then, okay, we're not at full employment, but, we're good neoclassical economists, and we'd say, okay, well, we just got to have prices be more flexible, and we'll let some deflation happen, and then that's going to move the economy to full employment to this point here, right? Great. But the accumulating impact of the government surplus is moving this aggregate demand curve. So now we shift to here. So this could happen again, and then again, and then again. So you're getting deflation. Even if price changes could move the economy to full employment, you're getting this continuous deflation. And think about this more realistically. Well, what might you do if you're a business and you're facing demand that's always less than your supply capacity? Well, there's a good paper by Nathan Tankis and Luke Karine that calls this market governance. You want to avoid ruinous competition. You want to avoid price wars that are going to lead to mass bankruptcies and destroy your business, right? The mainstream crudely calls this sticky prices, but what I think we would say is this is a sensible response to living in this kind of economy, where you don't want your prices to just be, rapidly responding to demand changes if demand is going to be deficient most of the time. So what do we do here? Well, in this version of the model, I've just frozen private price adjustments. That's this orange line in the top left graph. Private prices are just fixed, okay? Now the government price, because we let the government try to pay market prices for stuff, eventually it's going to reach the private price. Now it didn't have to do that. That's a policy choice. But given this current policy, the government price is going to eventually equal the private price. Okay, so that's what's going on there. But in this bottom right graph, this blue line here is unfilled demand for money. This is people offering labor to buy money and finding that there's no one to sell them the money. This is involuntary unemployment. So if the private sector does what's logical in the face of deficient demand, if they freeze prices, then we get unemployment, right? So we freeze price adjustment in that version of the model, and the government eventually adopts the market price, and it creates involuntary unemployment. Flexible prices, though, would not lead to full employment in this world. That's the key thing here. Instead, it would lead to a catastrophic deflationary collapse. So I think this is the last thing. This is just again, a heuristic, but a heuristic way to think of the economy, because my problem with the previous aggregate demand graph from before is that it seemed to think that price adjustments could lead to full employment, even just in the short run. I really don't think that's true. And if you read the textbook reasons for why the aggregate demand curve should be like a gentle downward slope that makes it intersect the aggregate supply curve, the reasons make no sense whatsoever. So I think a more, if you're going to have some heuristic, simplified picture of the economy, maybe it should look something like this. Here's your level of aggregate demand. Here's your level of aggregate supply. The government's fiscal policy forces that aggregate demand curve to move, and it might be moving continuously unless they do something, just slowly moving in one direction. But prices don't generally adjust because we have administered prices, we have market governance and frozen prices, unless you really get kind of far outside the normal range of business here, right? Really, there's too low demand. Businesses are going to start having problems and start needing to do panic selling and stuff. On the other hand, when demand gets too high, you start creating like market powers and shortages and start forcing prices up. So, but in normal times, we're living in this world where even though demand isn't equal to supply and price changes couldn't make it be equal to supply, we don't have changing prices or changing price level. Yeah. Okay, so conclusions. The currency is a public monopoly. Monopolists set price, and only the monopolist can ensure that there's enough supply to meet the demand. A couple things I'd like to add to the model. Again, I think it's a simplified world, and that's the point. It's a communication tool, but I think it would be cool to add multiple goods, especially like multiple buffer stocks. Like what happens if they're trying to run a gold standard and a silver standard at the same time? I think that's kind of cool. And then also like bonds, lending, interest rates, that kind of stuff. So that's it.